Ideal time to be speaking about markets. We've seen such a surge in energy prices in particular, prompting concerns about inflation. Has that perhaps reset your expectations for the year and how you're positioning for 2022?
Well, I definitely would have chosen a slightly better timing to come to you than this morning. It was some very busy 48 hours. I think what we advise our clients at this stage is really focus on the fundamentals and keep calm. And I think if you reassess the situation before the Ukraine event, everybody was talking about monetary policy divergence, Asia versus probably tightening, as we heard earlier, in the US and Europe. We actually do believe that fundamental case hasn't changed since yesterday. Clearly, very unfortunate events which will drive inflation pressure further. So hence, I would actually argue it has just further accelerated our scenario of monetary policy divergence in these regions as well.
So fundamentals intact, does that mean that it warrants a 50 basis point hike from the Fed come March?
So I think the situation right now is a little bit fluid because it will probably also a little bit depend on how fast additional oil supply is provided to the markets. I would think the pressure is probably more right now on the US. However, when you look at the European markets, there is definitely more pressure on inflation from the oil prices. I think about 50% of inflation in Europe is coming from energy prices. That will probably impact the acting of ECBC, or certainly from our perspective, to be assessed, right?
Right. And in terms of Europe, we've seen Europe be on a tear until just recently. Do you see that capital outflows from Europe to Asia, perhaps even to the US, or will investors keep to the safe havens?
So our scenario before the events was that actually there is probably not a bad timing right now to reassess emerging markets and China. We see actually flows into emerging markets as a 20-year low right now. And if you look at valuations, you could argue that the difference, let's take China A shares, right? We are right now at a 50% discount in terms of valuation to the S&P 500. Now, we are not advocating that it is smooth sailing right now in China or in the emerging market for that matter. But I think if you look at the monetary policies, certainly this region is more accommodative going forward.
You talk about China. You have exposure to Chinese real estate. What do you make of that space?
So I think if you look at China as a whole, as a macro point, right, it will take time for China to work that real estate problem out of the system. It's 30% of the GDP. So we will expect that to be continuous to be a pain point. Likewise, the sentiment in the market due regulatory pressures will remain very sensitive, right? On the flip side, however, I would think that policymakers were very clear. Economic stability is a core priority. We think that monetary policies will be supportive, which, by the way, is a plus for China bonds, and particularly China government bonds. And I would also argue the big mega trends that we have been advocating in China, they're actually intact, right? And those are going digital. It's around the focus on getting health for the aging population. It's around the finance system that I think needs to support a growing middle wealth income class.
And so you're anticipating more stimulus from the PBOC, from the government. Is that enough for you to stay invested in high yield property bonds?
So I think it's a question of what your positions that you already have, right? I'm not advocating this is a good time to buy it, but if you hold it, we think it's probably a good time to just ride it out, depending on where you're invested in. Where we make a call for very clearly is China government bonds, because I do believe that is to some extent the safe haven around the inflationary policies that you have around the globe.
When we talk about China, we have to talk about Hong Kong and that zero COVID policy. Of course, Hong Kong reeling from that policy alone. Is it getting difficult to hire in a market like Hong Kong?
Well, I have to say, having lived there myself for 16 years, it's very challenging right now to attract talent, needless to say, right? So as an employee there, that will remain a big challenge. I also think international investors are very cautious. We clearly have a preference of A share versus H shares because the market sensitivity in the H market are just way, way more elevated.
So in terms of what you have just said, will it affect Hong Kong's status as a financial center?
So I think as a CEO in this region, right, we need to assess where can I attract talent. And just to give you an example, I have been very strongly advocating our Sustainability Institute here in Singapore, and we have just doubled our headcount in the region around sustainability. Most of these headcounts were clearly not in Hong Kong.
You know, you talk about being still excited about China. Are you as excited about India? We're just about to see the IPO LIC, which is going to be the biggest IPO for India. Are you excited about the Indian market? I mean, we've seen such a massive sell-off recently.
So I think we're a bit more cautious at this stage around the Indian market. Where we think we're a bit more constructive is certainly around Indian government bonds, because we believe that the government sort of like has inflation in check. Now, fair to say, with the Ukraine situation, we need to reassess a little bit the pressure on energy prices in India. But I would say in context of the Indian market, there are attractive companies coming to markets, continue to come to markets, but we are a little more cautious at the moment.
You're very big on ESG. It is a huge theme in your investments. But greenwashing increasingly an issue. How are you putting pressure in the companies that you're invested in to perhaps be more accountable? So
I think first we walk the talk, right? As a firm, Abrdn has committed to reduce the carbon intensity of the asset that we are managing by 50% in 2030. What that means is that we provide tools, analytics, where when we invest in companies, we engage proactively with them and have a discussion around how we can help them also to address the issues that investors have. Further, I think we need to probably, particularly in this region, accelerate the dialogue with the regulators, because one of the big challenges we have is that regulators across Europe and the world have slightly different interpretations of what needs to be done, which is one of the reasons why we have launched the institute here in the region, right? And I need to stress what I'm quite excited about. We've also just announced that we have hired and launched a so-called early career graduate program for sustainable talents. So we actually want to contribute to that development of talents in this market over here.